Welcome everyone. Thank you for joining us today for the October results of the Business Risk Index, our second iteration of the index. And as always, joined by James O'Donnell, the Managing Director of Open Analytics and the creator of the index. Welcome, James.
Thanks, Patrick. Always good to be here.
Thanks for joining us. So looking forward to the presentation today. Some new stats. For those of you that have joined last time or followed any of the details as we've released some of these results from last month, is we have tons and tons of different graphs, different statistics, different ways of reporting on the Business Risk Index on a monthly basis. So every month is going to feel a little bit different. It will change up based on the numbers and the results and the trends that we're seeing. I think also it'll be driven quite a bit by seasonality. We're obviously coming into December, Jan, which is typically a quieter period for most businesses, but it'll be great to be able to see hopefully positive changes in both the retail and accommodation, hospitality, food and beverage services sectors as well. But today we'll be talking about the October results that we've seen come and gone. Of course, October very much affected by lockdown, we'll let James get into the stats. But before we do that, of course, please ask any questions. You can do that in the question box in the GoToWebinar control panel. As always, CreditorWatch, commercial credit reporting agency with over 50,000 companies across Australia using CreditorWatch to perform a wide variety of credit management tasks, including client onboarding, due diligence using credit reports, credit scores, payment ratings, monitoring and alerts to keep an eye on your customers, very important. It's great if you do an upfront check, but what happens if they start to fail or head towards delinquency, the next week, month, year? Set up monitoring and alerts, and we will send through proactive email alerts to you to let you know how your customers are performing. And of course, we're all about automation too. So if you're keen to integrate company data, risk data, any of these processes you want to automate, CreditorWatch can assist there as well. The next slide looks at some key highlights. So how is it that we're able to sit here and create an actual index? Obviously, we've got James. He's on my right there anyway in the screen. Him and his Open Analytics team have utilized the data and put together beautiful models to create the index itself. But the data we're pulling in from a wide variety of sources, public, private, and government, of course. Huge amounts of information coming through, in particular trade receivables data, and at about 90% of our customers are unique. So the insights that we're getting are simply not available anywhere else in Australia. So with that in mind, I think it's best that I pass over to James and he can start the presentation.
Great, thanks very much, Pat. All right, so look, I'll dive straight into what we found as the key results for this month.
Sorry, James, I think we just lost your video for some reason.
Oh,
just see if you, there we go, you're back.
Hopefully everyone can see me now. Okay. All right, so look, the key results for October. So look, starting with the best and worst performers. So just a recap of what the index is, because it's still quite new. So it's a ranking of regions by insolvency risk. So as a general rule, businesses that get an index of say less than 20 tend to be very high risk, and I'd say sort of more than 80 are very low risk regions. So to start with the extremes of the scale, so the best and worst regions within the country. As we reported last month, it's very much a case that the Gold Coast and Western Sydney remain the highest risk regions, and we think that'll be the case for quite a while. On the other side, there's a bit of a mixed bag of the sort of low risk regions. They all tend to be regional areas. So quite a number within Victoria, sort of the Murray and Swan Hill region, Moree, Narrabri in New South Wales, and then the Limestone Coast in South Australia. So they're the sort of they're the sort of best and worst performers, but a few other regions that we've been drilling into this month. So I think last month we talked quite a bit about the regional outperforming the urban and city centres, and that's still very much the case. Last time we talked about the agribusiness regions, so places like the wheat belt in WA, Mackay in Queensland, the sugarcane capital, and in fact, all the wineries around the country, those sort of regions like the Yarra and Hunter Valley, all performing quite well. The one we've been digging into this month is the second sort of bullet point there, is around the energies that are driven by sort of the largest sort of green energy projects in Australia. So two sort of call outs there that we've been digging into are around Griffith in the Riverina area. So of course, Australia's sort of largest solar project is in that region. And then also within South Australia, the mid-north and the regions around the Hornsdale wind farm. So both of those regions actually sort of appear in sort of the top 10%. So they're very low insolvency risk, really good sort of average credit scores for those regions. So they're probably the key sort of call outs there. Then the other thing we've been sort of looking a bit at sort of filtering down to the larger population centres. So we report the index on any region that has at least 1,000 credit active businesses in it. So we sort of cut out some of those sort of regional and outback areas that don't have much of a population in there. But you'll notice a lot of those sort of low risk regions are relatively low population base areas. So what we're doing now is sort of filtering down to areas with either 5,000 or 10,000 plus businesses. And what that tends to do is sort of filter down to the big sort of urban and city centre areas. So the chart up on the screen there, sort of looking at the really big end of town. So regions with at least sort of 10,000 credit active companies in them. So on the sort of plus side, actually a lot of northern Sydney. So sort of the regions around sort of Chatswood and Lane Cove, Ku-ring-gai, North Sydney. So of the really large population centres, they tend to be the best performing. The other big one there is Perth City, which is by far one of the best of the CBDs. The flip side, in terms of the, sorry, just lost my slides there for a sec. All good. Yeah, so you can see sort of Brisbane and Melbourne are there on the sort of the weaker side. So Melbourne has actually deteriorated quite a bit over the last, I'd say, 12 months, and it's probably the biggest sort of deterioration in the major city centres. And then just on the same sort of topic, now we're sort of looking at movements in the index. So who have been the movers up or down the rankings? So here I've sort of chosen to filter on 5,000 just because there was a few more interesting regions that sort of crept in just below that sort of 10,000 mark. Some of the key ones there is around Victoria. So Kingston, a regional part of Victoria. So one of the themes that we're sort of seeing is within Victoria in particular, you're seeing this sort of quite a big split between regional areas. So we've got sort of Kingston here. There was 3 sort of Victoria regions in the absolute best performers. So a lot of sort of regional Victoria is going really well. But on the flip side, both sort of the Melbourne CBD, but also some of the outer suburbs of Melbourne, you can sort of see there to the right of the chart there. Some of those regions have deteriorated quite a bit. Other sort of call outs is we've got sort of Geelong in Victoria. Geelong's an interesting one. It's deteriorated a bit over the last quarter, but it's still quite a bit better than average. So I'd still say the story there is still pretty positive. Okay, so next up, and sort of the final sort of piece on the BRI is our sort of trade receivables growth. So we've been sort of tracking our data suppliers' business activity, and we do that by looking at their receivables growth. We've showed this a number of times, and of course there's that sort of JobKeeper period where there was quite a big contraction. Unfortunately, the October data, again, a pretty weak month, so 37% contraction on year there. But you recall that sort of October, that's still quite heavily affected by the lockdowns. And then look, we're prepared to kind of stick our neck out and predict that will turn around between now and Christmas. So we'll be very surprised as everyone sort of comes out of lockdown and we get the sort of November, December data that starts to trend in the right direction.
And James, just on that, it sort of feels that there's obvious sectors that'll perform better through December. Jan's typically quiet for most, and then Feb, I think most business owners, managers, people are just hanging out for that. They want a holiday, but then they're also hoping no lockdowns between now and then. Feb's really the takeoff month for the economy.
Yeah, and obviously the kind of shop fronts, retail trade, and that sort of thing should see the biggest spike. I'd be surprised if, even in the last 2 weeks, I'd imagine there's quite a bit of business turnover from what I'm seeing walking around the city and where I live. Okay, so then I guess the geographic view of the world in terms of what's going on. I might hand over to Patrick to talk a bit more about some of the other insights we've seen this month.
Yeah, thanks for that. So this is, again, looking at probability of default by industry, and this is the chance essentially of a business within a specific industry failing in the next 12 months. What is, again, no surprise, food and beverage services coming in at #1 by a long margin, but we've actually seen improvements for arts and rec, and sort of coming back down closer almost to the average. Education and training also up there and very reliant on of course international students coming in. At the other end of the spectrum, we've still got mining performing extremely strongly, which is no surprise. Healthcare and social services is second best, and then manufacturing, wholesale trade very closely aligned there, which is really important. I think calling out some other larger ones that should be called out. Retail trade sort of sitting in the middle there, which is good to see, being propped up no doubt by that huge e-commerce boom that we've seen, plus people not able to travel, spending their money with shops, whether it's online or not. And then of course construction there down towards the lower risk end of the scale, which is great. And that sort of contradicts one of the slides that we'll see in a little bit. And here we go. Construction, despite the fact that they're I think they were 5th or 6th less risky industry for October, still the slowest payer. So almost 12.5% of all construction firms paying 60 days overdue. So the one thing we've said about construction is they are consistent, if nothing else. So consistently slow payers, and typically that can blow out a bit, correct, James, over December and Jan as well, as work slows or stops, and of course progress payments don't come through.
Yeah, that's true. Yeah.
The other ones, of course, food and beverage still there, transport, postal and warehousing. We're expecting that to change quite a bit as the borders reopen. So I think people naturally think, oh, hold on, e-commerce boom, warehousing, postal, but you've got to think about Qantas, Virgin, Rex, Greyhound, trains, planes and automobiles. So all of that obviously falling into transport, postal and warehousing. That'll turn quite quickly, I'd imagine. Retail trade, one of the slower payers, which is to be expected, but no other real surprises in there, which is good to see. This will be a nice one to track over time as well. I think in the future we'll probably start to call out some specific industries to see how they've changed from the middle of lockdown, or at least October, to what they potentially look like come Feb, March, when everything's back and open. So the next one, we're looking at those, those traditional sort of statistics that we've always reported on around credit inquiries, court actions, insolvencies, payment defaults. So credit inquiries through here, we've seen it remain very flat. Obviously started to climb in the new year. The huge amount of activity there in January. Climbed through to the middle of the year where it sort of stagnated, plateaued, and it's come off a bit. Lockdowns obviously hit very hard. However, as you can see, it's still up above or close to where we were this time last year. So the fact that we were in extended lockdown for pretty much the whole of the East Coast, still positive to see that. I think the lesson here is that businesses have learned how to trade through lockdowns and how to continue running, whereas the first time around with COVID last year and the initial lockdowns was very much everyone shut up shop and just treaded water. So positive to see that the engines are still moving there, and while we don't expect to see some big numbers in November, December, Jan coming out of into the new year, sorry, we will see that start to climb somewhat. Next one there. The most reported stat, I think, after COVID cases and now vaccinations would be external administrations or insolvencies. So again fell away in October. Lack of business activity does that. And of course, the banks and the ATO, the biggest creditors in Australia, really holding back on that final forcible bit of collection that they would use in terms of winding up and putting companies into administration. Still not expecting to see them get back into that normal routine until probably, you know, middle of next year. So probably expecting sort of April, May, June. The banks will probably start a touch sooner than that, and I think James, we're sort of starting to see a bit more out of the banks with that regard.
Yeah, I think the story is that the major banks are starting to move back to normal collections rhythms, but I think the ATO, who is actually the biggest creditor, or we suspect that they'll hold off a bit longer. But look, we're sort of expecting to see sometime in the next 6 months that the insolvencies, they look like they've bottomed out and they're about to start heading north.
Yeah, so there's going to be a sustained increase. We think we're not expecting a flood or a wave or a big step change in insolvencies. So I think the big narrative to everyone, whether it's media or credit managers or debtors, whoever it is that's out there, that not to be alarmed by it. It is going to happen. We have to get back up to, you can see there, Feb and March, sort of high 700s, low 800s. That's the standard through most of the year, bar December and January. We have to get back up to that pace. So expect to see that happen through the start of the year. A nice steady climb is what we want to see rather than a jump. Court actions. Interestingly, we saw some big jumps through August and September as some of the states came back online and got back into normal sort of rhythms, particularly out of WA and even I believe Queensland too. South Australia, it's come back off though. I think we've probably seen some big a big volume of cases sort of push through all at once, and that's sort of come back off again. Again, similar story to administrations. We expect to see that start to climb. Banks and ATO being big creditors within this space. And that is it for today. Nice and easy, nice and quick. I think the important thing to remember is that you can jump online and have a look at the Business Risk Index live. It is interactive as well, so don't be shy to go in, have a look at that Australian map of Australia, and you can have a look at the various regions that are available. The other things as well, national probability of default is available via state and industry, of course, and also you're able to see the receivables growth change over time, which is a bit of a scary one, but we're hoping to see a Disneyland type ride back up to the top of the roller coaster as revenue comes back online, particularly in the new year. Just going to check to have a look at questions. So we've got some coming through. It would be great to color code to reflect the number of businesses per region in the data. So I think if we share the stats, but if you have a look at the sort of small print towards the top of those graphs, it does have that X number of businesses, over 5,000 businesses or 1,000 businesses, for example. And then if you jump into the website, you can see the various industries, the various regions as well, and they are mapped in a different color-coded way depending on how they're performing. The riskier they are, the redder they are. In fact, I might take back over as presenter and I will show those things. Give me 1 second to do this. All right, there we go. So I'm on the receivables. So good, what I'm talking about here as an example, you can have a look through as you scroll over the various industries. You can start to have a look at which ones are performing well and which ones are not performing well. You can also do that at a state basis as well and start to play with the information itself.
And I believe on that hover map.
All right, keeping on with the question, I'm showing that for a second. All right, what type of finance? James, you and I spoke about this, I think it was last week or 2 weeks ago. There's particularly a lot of pressure on smaller either brokers and also the smaller lenders. Is that correct?
Yeah, and the financial services don't think banks, think basically financial advisors and brokers is I think a lot of people will think of the big end of town when they see that category, but if you look by number, most of them are sort of that type of business, and they're the ones that are struggling. I mean, creditors are not kind of struggling in terms of credit risk. They're more kind of low application volumes and lower revenues, but
yeah. The next question here, how do you expect the construction industry to fare over the next 6 months? I think I'll go first here and then you can jump in, James, but there's a lot of challenges for the construction industry. Obvious ones being supply chain issues, so they simply can't get the materials required to perform the job. I think the COVID restrictions have put pressure on them, but that they will obviously be weaned off those restrictions, which is a positive thing, so they can get more people on site to finish jobs. What are your thoughts there, James?
Yeah, I think it actually might vary by state. So actually, as you mentioned, I think it actually might be correlated to the vaccination rates. So within sort of New South Wales and Victoria, where we're sort of hitting those 90 or 95%, then those sort of restrictions will be less, but potentially in sort of areas like Queensland, where they're lower vax rates, there could be some issues. We're seeing nothing in the data that says there's any real sort of pain heading for the construction industry. So I don't know if you can hear me, but I've totally lost my sound, so I didn't hear any of that question.
That's all right. Can you hear me now?
Yeah, you're back. Sorry.
Great, sorry everyone. Bit of a technical issue there. I'm not sure if it was my end or your end, but I might just move on to the next question in case it was just at my end. Business turnover suffered its largest contraction since the start of the pandemic. What was responsible for this, and how is this likely to track moving forward? Very good question. Look, I think from my perspective, if you have a look at that graph when we send it back through, the turnover was kind of coming into late 2019, early 2020, and there was a couple of reasons for that. The economy certainly wasn't performing as well as it had been previously. We'd had a New South Wales and federal election, which slowed things down. We then had fires, floods, and all sorts of things like that, which put a huge amount of pressure on businesses and the regions in particular. We then got hit by COVID. JobKeeper pumped it back up as the country opened back up through the end of 2020, early couple of months of 21. March, we saw the JobKeeper come off, and there was an immediate downturn straight away. And of course, we had Melbourne going in and out of lockdown, but there was sort of a lot more free money around. I'll say a lot more stimulus. And then of course, sort of June onwards, we got hit by that Delta variant really hard, and that's come right back off as well. So I think they're probably the most important things. James, your thoughts on that?
I think it's more or less as simple as the lockdowns. The businesses. Not like there's some sectors that are going okay, but all the retail trade has really sort of collapsed. The other sort of thing is that over that period, business and consumer savings have gone up quite a lot. So in terms of why we're sort of optimistic, the cash in the accounts of businesses and individuals is sort of higher than it's ever been at the moment. So that sort of points to when we do open up, there should be more spending and more business turnover.
Yeah, nice one. A good question here, which I can answer quite quickly. Do you have probability default or risk score by sub-industry? At this stage, no. So when we're reporting from a business risk index perspective, we're reporting just at that top, I believe it's a division of the ANZIC classification. We do intend to start to be able to delve deeper into that in the future, but we're just starting at that high level for now. Do you anticipate rate rise in 2022 will impact business significantly, or will they weather this impact? Good question. I think this comes up regularly, not just obviously in CreditorWatch webinars, but all over the place. James, what's your 2 cents? The RBA's it doubled down, it tripled down, and then it sort of come back off the last meeting that it's had, but it's still very very confident that 2024 is its rate rise year.
Yeah, it's hard to predict. I think they should raise them. Well, obviously it's a bit of a different topic, but the kind of, you know, overheated property market that is obviously driven by very low interest rates. So, I mean, you could give the generic answers around the, you know, the inflation's getting towards the target, so it should be risen. So I'd say I'd hope it is, but I don't know.
Yeah. Look, I think it'll be debated strongly every single month between now and when those rates finally rise or inflation significantly comes off. Which I don't know if you've been to if you filled up your car with petrol lately. Doesn't feel like inflation's going to go south anytime soon. One last question that we've got here. It's around the payment arrears in the particularly in the construction industry. Has the construction figures been adjusted for retention invoice amount, which I understand is unique to that industry? James, you want to have a go at that?
So, look, around retention payments. So, yeah, we measure the arrears from the due date. So, you know, we are actually dependent on the suppliers sort of getting that right. So we believe in general, yes, we are capturing that. Although it touches on the point that I think Patrick began to make, that, yeah, a lot of construction, yeah, there's project finances, and there's obviously effects from project overruns and things like that. And that's why it's, for construction, the arrears isn't as correlated to insolvencies as pretty much any other industry.
Yeah, that's right. Some really basic things there that jobs have blown out a little bit as a result of COVID restrictions and lockdowns, and then all of a sudden the scheduled payment doesn't come in, you know, in that expected week. It comes in, you know, week 2, 3, 4, 5 down the track. So that's certainly putting pressure on the payments within that industry. All right, I think that's everything. That's all the questions that have come through there. So I'd encourage you to jump onto the website creditorwatch.com.au/business risk index, or you can just go to the CreditorWatch homepage, and there's a link on the homepage as well. Go in, interrogate the data, have a look at the graphs, get interactive with it, and see if you can find anything of note that you'd like us to raise this time next month. But until then, James, thanks very much. Always great to have you on board, and some fantastic insights as well. Plenty of hard work that goes into it.
Thanks, Pat. Thanks for having me.
No worries. Thank you, everyone, and we will chat to you very soon. Cheers. Bye.